Hello friends, in this video we want to talk about the price action. When a supply or demand gets tested different times, we know that soon or later the zone will eventually break. When we see a strong break from a supply zone, we know that bulls did buy there. Therefore, we don't consider this zone as supply anymore, but instead we consider to be a demand zone now and vice versa for a broken demand zone. Supply became demand or demand became supply. This is also called a swap level. If the level was broken in a strong fashion, then we would look to buy or sell from a swap level when price will come to visit the level. Having a good supply or demand zone is not just enough to take a trade blindly. You have to make sure that the potential profit on the trade will be high enough. Make sure that the reward to risk is good enough by identifying where a previous supply or demand point was. As a final word, I would like to mention that supply and demand opportunities can be found in every time frame and in any trading market. Now that you know what to look for, I suggest that you go and find some examples for yourself on your charts. Try to master this, as I believe this is what will take your trading to some new levels. A support, also referred as floor, and resistance, also referred as ceiling, is nothing more than a decision level that first gets tested and then either accepted or rejected, thus broken. When price bounces from a support level, it does so because there was much more buying pressure than selling. Pressure at that particular point and vice versa for a resistance level. As you can see on the picture, when price came to test the resistance level, a decision was made. In this case, the decision was that price was too high, forcing price to trade down until it found a support level. If you search for support and resistance on the internet, you will probably find that lots of sources or traders think that the more a support or resistance level gets tested, the better. Obviously, this doesn't make sense at all, because every time price comes to test and support and resistance level, it consumes the sell or buy orders at every touch or retest. So sooner or later, old orders will get filled and a breakout will have to take place. When a breakout will happen, support will often become resistance or resistance will become support. When we went over the trends topic, you learned that in order to have an uptrend, price had to keep on making higher highs and higher lows and lower highs and lows for a downtrend. Now you will understand that the highs in an uptrend and the lows in a downtrend will have to get broken for the trend to continue its direction. There are really no fixed rules to draw support and resistance levels. Often the easiest way to draw a support or resistance level is to use a line chart. Let's look at a line chart and find some support and resistance levels, looking for key tops and bottoms with at least 2 touches in order to draw a horizontal line. What we want to find are turning points or swing points and mark them. Sometimes you will see price arriving at a support or resistance level and trying to break the line, trading above the resistance or below the support and then quickly pulling back and closing under the resistance line or above a support line. This is what is called a false breakout or fake out. A fake out happens for different reasons. One of the reasons is that price is looking for liquidity or a stop-loss hunt. We are not able to know how many touches support or resistance can accept. We can only know that it often becomes the opposite once it is clearly broken. When we get a false breakout or a support or resistance level, while it's breaking out, it will very often react to a previous decision point. A support or resistance area is not totally the same as a supply or demand level. A supply or demand level is an area where the real orders are placed, while a support or resistance area is where we can spot the retest of the fresh supply or demand levels. However, we believe that every historical price line, such as support and resistance, are based on a historical supply or demand level. Support and resistance areas can be spotted on any chart and on any time frame. However, the higher time frames supply and demand zones are much stronger than the lower time frame ones. In order to be able to trade the markets, we need to be able to understand why price is where it is and where it will go to next. The best indicator for all this is price itself. It holds all the clues you'll ever need to work the market out. We do our trading at levels called supply and demand zones, and we watch price action there to give us signs as to the intention of the big money. During the formation of a base, we consider price to be in balance. This is because there is not a significant difference in the amount of buy or sell orders in this area, thus price doesn't rally or drop as long as this balance exists. For price to start moving in a direction, there needs to be more of one type of order, buys or sells, than the other, causing price to rally or to drop. It is at this point a base is confirmed and a decision that price was either too cheap or too expensive has been made. When price moves away from a base, there are naturally unfilled orders which remain. So when price returns to the base in the future, we can expect the remaining orders to be triggered, causing a reaction in price. It is this what supply or demand traders try and take advantage of. After a level is tested many times or during a strong move, supply and demand levels eventually break. This can be due to the once remaining orders being triggered and gradually removed, or an overwhelming amount of orders in the opposite direction breaking the level. Others can even be removed manually by a trader who formed the level. Every broken supply or demand level holds some significance. Where once were more sell orders or supply, now more buy orders remain or exist, with the opposite applying for demand levels. This means upon return to a broken level, we could see a reaction in price. These levels are often referred to as swap levels. Wouldn't it be nice if we were able to trade supply or demand levels knowing when one will hold or when one will break? Well, believe it or not, we can, because as hard as it may sound, supply or demand levels are not created equally. There are some that are much more important than others, and some even further beyond important. Most articles on supply or demand will mostly have you read about reaction to levels, because that is what is important, right? Sure, they are important if all you want to do is look at the far right of your charts and gamble. But what are the supply or demand levels themselves reactions to? Supply or demand levels can be reactions to other supply or demand levels, or support or resistance levels. Here is some help on defining these levels. But remember, to truly understand them, you need to find and mark them out for yourselves. There are plenty of other supply or demand levels which I didn't mark, but they would all hold lesser importance than the ones formed after the breaks of highs or low. However, important levels can also break, so it is important to monitor these levels for sign of reversals. When they break, however, they hold a lot of importance.